Hi. There's been a number of signals lately that there is a correction on its way. So I thought it would be helpful to look at what those signals are and, more importantly, what we should be doing about it. Firstly, the Baltic Dry Index has fallen off a cliff. This is the index that measures shipping capacity, and it was one of the harbingers of doom for the global financial crisis. So much more capacity than global trade warranted, and therefore an indication that demand for shipping and therefore global trade was diminishing. Many commentators are suggesting, though, that this is actually a supply side issue. That as we exited the global financial crisis a couple of years ago, many of the shipping lines ordered new fleet capacity, which is now coming online. Means maybe that yes, global trade is in a softer period, but it probably doesn't mean that we're re-entering the global financial crisis. The other is that we're looking at how markets react to good news coming out of the US. So you will have seen in the last few days that there was a market sell-off when stronger than expected employment figures came out of the US. This is an indication that there will be a strong market reaction, most probably negative, when Janet Yellen and the Federal Reserve actually do end up increasing rates. The bigger question, though, is what to do about it. And it reminds me sort of the phrase that they use continually in Game of Thrones, winter is coming. Yes, a correction is coming, but the larger question is when. And in fact, a correction is a natural part of the investing seasons that are important for all investors. When you look back at the post-war history, you can expect significant negative returns from equity portfolios, up to 30% declines in portfolio values every 5 years. So when looking at the opportunity cost of sitting out of the market, or more importantly, trying to time your exit from the market and then re-entry at the bottom of the market, you're almost guaranteed to get one of those two halves wrong, and therefore potentially significantly erode long-term returns. I think the better view is to deploy cash into the current market progressively, bit by bit, trying to just smooth out the volatility on the entry, and for fully invested portfolios to stay the course. When we see the correction, it may produce some good buying opportunities, and invariably dividend receipts actually decline far less than temporary capital value declines. So we look forward to staying the course together with you and riding the roller coaster together.